Alright, so let's take a look at a couple of these examples here. January 1st, 2015, Boston Enterprises issues bonds that have a $3,400,000 par value, mature in 20 years and pay 9% interest semi-annually on June 30th and December 31st. Bonds are sold at par value. How much interest will Boston pay in cash to the bondholders every 6 months? Okay, so 9% interest semi-annually means you're basically paying half of that twice per year. So we just take 3.4 million times 4.5%. This is half of our 9%, and that gives us $153,000 semi-annual cash interest payment. Journal entries for the following: issuance of the bonds on January 1st, 2015. Okay, so at that point, it's just going to be essentially the par value going in as cash to us and as long-term liability in the account bonds payable for the same amount. First interest payment, we already calculated it up there of $153,000, so we'll put that in there. Just debit to bond interest expense, credit to cash, and then the same thing for the second interest payment, only difference being the date there. Alright, on January 1st, okay, this is part 3 here. Prepare the journal entry for the issuance of the bonds, assuming the bonds are issued at 98% and the bonds are issued at 102. So issue at a discount versus issued at a premium. So if they're issued at a discount, that means we're only getting 98% of the cash. So just 98% times the cash. And then we still will owe the full $3.4 million at the end, so our bonds payable will stay the same. And the difference between the two will be the discount on bonds payable, as you see right there. So the same thing would be going the opposite direction, except now the cash we get up front here is going to be multiplied times 102%, so it's actually going to be more than the amount that we're going to have to pay back. The difference being now, instead of that being a discount, that will be a premium, and it will go on the credit side to balance out the journal entry. And then, of course, as we talked about in class, this is at the outset when the bonds are issued, and then as time goes by, the amount in this account goes down in equal increments over the course of this debt, and this is basically representing interest one way or the other. All right, TANO issues bonds with a par value of $180,000 on January 1st, 2015. The bond's annual contract rate is 8%. Interest is paid semi-annually June 30th and December 31st. Bonds mature in 3 years. The annual market rate at the date of issuance is 10%, and the bonds are sold for $170,862. What is the amount of discount on these bonds at issuance? Well, that's just going to be the difference between par value and the amount that we're actually getting for them. So the discount would be $9,138. How much total bond interest expense would be recognized over the life of these bonds? Well, it would be this amount here plus the semi-annual interest payments. All right. Straight line method to amortize the discount for these bonds. So basically, just take the discounted amount and divide it over these payment periods. So 1, 2, 3, 4, 5, 6, 7 payment periods. Oops. I'm sorry, it's 6 periods here, because the last line here we're going 0. Sorry, that threw me off for a minute there. So $1,523 per period. We'll subtract each period until we get down to 0. TANO issues bonds with a par value of $97,000 on January 1st, 2015. The bonds' annual contract rate is 10%, and interest paid semi-annually June 30th, December 31st. Bonds mature in 3 years. Annual market rate at the date of issuance is 12%, and the bonds are sold for $92,234. What is the amount of discount on these bonds at issuance? Again, $97,000 minus $92,234. What is the total bond interest expense that's recognized over this period? Actual bond interest expense, not including discount, which I think I misspoke on the last slide for that. So we just multiply the amount of interest payments times the percentage rate times par value, plus par value gives us the total amount we paid. Amount borrowed is the amount that we actually got paid. So this is where that 4766 comes into play, because instead of the amount borrowed being this number, it's this number, and so that's where that comes in as well. Total interest recognized over the life of the bonds then becomes the difference between those two. And then straight line method to amortize the discount. Again, all we're doing is dividing by 6. $7.94 per period. All right, Quattro Company issues bonds dated January 1st, 2015 with a par value of $400,000. The bond's annual contract rate is 13%, and interest is paid semi-annually June 30th and December 31st. Bonds mature in 3 years. The annual market rate at the date of issuance is 12%. Bonds are sold for $409,850. So now we got a premium. Again, we're just looking at the difference between par value and what we got. So the premium is $9,850. Total amount of bond interest expense that would be recognized over the life of these bonds. Now, basically, this amount will be subtracted from the 6 semi-annual interest payments. Which gives us finally that number there. And then again, straight line to amortize the premium, same way, it's just a premium instead of a discount now. Divide the amount of premium by the periods, and we get 1642 per period, which eventually brings the carrying value down to par value. And that's actually all we're going to pay today.